Hey everybody, Jeremy here. It is Saturday, March 18th in the evening. I'm going to be busy all day tomorrow, so doing this a day early for you to bring you the weekly market bias update. Taking a quick look at the indexes, starting with the spider. So the S&P 500, obviously still in a downtrend. On the daily chart here, nothing has changed on that front. We did have quite a bit of volatility this week, and actually the SPY ETF does not show that as much as the futures market does. If I click out to the futures market here, you can see all of these red lines with these giant wicks. These are after hours trading when the actual SPY was not. This massive candle here went all the way from 38.40 up to 39.75. Basically, it was a 132 point move on the day. And just to put that in perspective, the average true range for one day's movement is about 78 right now. So it was almost double the normal day's range on that candle. Lot of indecision, lot of back and forth. At one point had just broken down and looked like it was just destined to hit 3,800. The bulls came back a little bit, and just for anyone that doesn't know what this volatility was about, we had some economic reports in last week that were important, but they all got overshadowed by calls for the financial institutions basically crumbling in front of our very eyes. So SIVB and Silvergate Capital, SI. Both of those ticker symbols were small banks, regional banks that basically went belly up. SI was actually connected to the crypto space, and there was just a run on the banks, people withdrawing funds. The banks got to a place where they didn't have the assets to cover their liabilities and ended up going under. And that impacts the rest of the banking sectors, even though larger banks like Wells Fargo or Bank of America or things like that don't have as much direct exposure. They still do have exposure. And so basically the financial sector, XLF for the ETF across the board just got hammered. You can see it was above all of its moving averages. It was sitting here setting ready to break out, and then just got pummeled on the news. And there's really no end in sight to this yet. There is a lot of talk about the government stepping in and basically ensuring positions in those banks to prevent people from continuing the run on the banks and continuing to withdraw, hoping that that's enough to stop the bleeding so these banks can recover. But right now, we're looking at about $30 support for XLF, and it's below its 200 now from this last week. So this is probably a stay away until we get some more news developed. I know a lot of people would probably be excited to buy this on a discount, and it's hard to catch a falling knife, and it is not advised to catch a falling knife. So when things are in free fall like this, don't try to be the first one to jump back in. Wait for that to settle down. Wait for true bottoming patterns to form, and allow that volatility to settle out a little bit before you risk your hard-earned money. So anyways, this was kind of the fallout for all that volatility that you were seeing on the S&P 500 futures. But back to the SPY here. Obviously in a downtrend, it lost all of its moving averages over the last week or two. You have to be looking at this probably as a bearish retracement, meaning that if we see it roll over and start to head lower again, back down to this 38 or even 376 level, 380 or 376 level is probably in the cards. I'm not going to be able to look at this and say that I am bullish again until we have closed back above this 50-period moving average, just above 400. So that's kind of the line in the sand where if we can close back above that and then get some kind of bullish pattern, I will jump in. But until that happens, it's kind of a stay away for me and just looking selectively at certain stocks. Again, kicking this out to a weekly chart, really the support on weekly actually shows coming down to 371 or 372. So anything between current prices and that range is probably just a stay away and waiting for this to develop and see what happens. If we go out to the Dow Jones really quick, nothing to see here. Same kind of picture. It's broken its moving averages on the weekly, probably looking at a retest down here to around 306 on that 200 period moving average. If we go to the Russell is actually the weakest looking one out of the bunch here, and that is because of its exposure to a lot of the small regional banks. So it shouldn't be of any surprise that the major index that houses so many of those smaller regional banks that really got caught up in the fire sale this last week is getting hit the hardest. Diagonal support broke, all the moving averages support broke. For longer term investors, if you want to lob some naked puts down around the 160, 163 level, somewhere in there, looking for assignment for a longer term position and cash flowing in the meantime, feel free. But it's not my cup of tea. We really need to see this volatility settle out a little bit here. Daily chart, same thing, just huge sell-off. And this chart's going to need a little while. If we can get some kind of a consolidation period like we had here from mid-December through until the first week of January, and then a trigger higher, I would like that. But otherwise, this is kind of a stay away. It's interesting that actually technology has taken the reins, even though technology is hurt by raising interest rates, and we are slated for another interest rate increase here coming this next week. That will be announced at 11 a.m. Pacific Standard Time on Wednesday, and then a little Q&A session with Jay Powell, the president of the Federal Reserve, at 11:30. But even though interest rates being raised hurts big tech and technology in general, there's kind of a sense of a flight to safety to big names like Apple or Microsoft. You can see Apple fighting here, actually a nice looking breakout above about 158. Microsoft, just to take a look, had a massive run from the bottom to top right here. They went 15% from their little double bottom they put in here over the last few weeks. That is a massive, massive move for Microsoft. Same thing in Amazon. Just showing you a few of these here. Amazon not as pronounced, but still took a run of about 14%. So, these are really big movements for these large cap tech stocks. And even though they are still obviously struggling a little bit because of higher interest rates, I think there is a flight to safety mentality of people being more willing to buy these kinds of companies on a dip because of the fact that even if interest rates are high, even if inflation stays high for a while, that these big organizations have the cash to be able to withstand that kind of an economic disaster. Whereas some of the small caps in IWM, like we were just looking at, just simply don't. And there is a fear of some of these companies contained in the Russell 2000 potentially going bankrupt. And nothing scares investors more than thinking that their stock might actually go to zero. So people are just jumping ship on IWM. Overall, I would rank that the NASDAQ is the strongest right now of the four indexes. IWM is the weakest. And then the S&P 500 and the Dow Jones are both kind of in that like bearish, but not as bearish as IWM. So anyways, it's not looking particularly great on those. One more thing to actually point out on the NASDAQ chart, if we drop this out to a weekly, it actually, because of the large cap tech stocks that performed really well today or this last week, it actually has a nice bullish trigger on that. I don't know how aggressive I'm going to be. Obviously not very aggressive until after the Federal Reserve meeting on Wednesday. But interesting to note that that's actually the first close with follow through, big volume, MACD moving higher, good RSI values. So in any other market condition, this would be a all signs go, let's just rip kind of setup. It is a beautiful double bottom pattern, broke out, pulled back, retested the same level there. and now is moving higher. But because of the economic uncertainty that we have right now, you have to take that in consideration. So where I would normally be very bullish on this bottoming pattern and this trigger, I'm going to be much more cautious right now. And if we go out to the SPY, or no, it wasn't the SPY. Which one was it? Was it the Russell? No. No, it was the SPY. I'm looking at a weekly. My bad. Yeah, so the SPY here, still obviously downtrend. It has that 50 period moving average above it. I wouldn't be surprised to see it just chop back and forth for a few days in this range, staying fairly tight to where it is now until the Federal Reserve meeting happens. And then we'll see if Jay Powell and the Federal Reserve decides to only raise 25 basis points instead of 50, which was thought to be the case here about 2 weeks ago. But now with the banking issues that are going on, people are pricing in a 25 basis point rate hike. So if that happens, I'm guessing we're probably going to go sideways here for a few days and might even see an increase to the upside if we only do 25 basis points and if they signal they might be pausing sometime soon. But that's a big ask. So right now, there's not really a clear way to read this. You have huge down day, huge up day, huge down day, huge up day, another big down day. This volatility seems to be here for a little while. And actually, that's a great segue into the VIX. So if nobody here knows what the VIX is, the VIX, VIX ticker symbol, is the Market Volatility Index. And a very short lesson on this, if you are at a VIX reading below 20, that is considered to be low volatility, and above 30 is considered to be high volatility. So obviously, when you have big market sell-offs or big indecision candles like we've had recently on the SPY, the VIX is going to spike quite drastically. And you can see we actually went all the way up above 30, settled back down and pulled back kind of into the middle of the range here after the government said that they might support the banks that are struggling right now. But this is a really good indication of the fear mentality that is in the market. So anytime the VIX is low, that's a time that I start looking at potentially buying options because options are cheaper when the VIX is low. Anytime it is above 30, I start looking to sell options, collecting those premiums because you can get paid more for taking on that risk. So anyways, the volatility is basically right in the middle right now, closed at 25.50. Nothing to see immediately here, but just knowing those extremes. And you'll notice that I actually always have alerts set to let me know when we break the high or low extreme there, because that's going to inform my trading decision. Finally, last but not least, let's look at gold really quick. GDX is the miners ETF. It tends to be a little bit more volatile than gold itself as the physical asset. And it has some catch up to do. So if we look at gold, the physical asset, it is breaking out. And I don't see any reason this won't come up to around maybe 190 before it runs out of steam. It might pull back and kind of chop a little bit on the way, but I'm kind of targeting that 190 area for gold positions. And then for the miners, you can see this is kind of a different story, whereas gold has already gone up quite considerably. The miners are just now starting to wake up here. So in my opinion, there is a decent chance for these miners to be able to push higher again. I like GDX. One that I really like usually is NEM, although I haven't looked at the chart recently. Let's take a look at that on the weekly. I actually don't mind that chart either. We had a big rounding bottom. It did pull back and kind of gave us a little bit of a rising double bottom there. And now is pushing higher. I could easily see it coming back up to about 52.5 to this weekly 50 period moving average, if not back up to the previous highs up here on the weekly, probably about 55. I'm going to discount that wick because there's enough resistance there around 55 that I think that would probably be my target for it. But if we get a break above these daily moving averages there, I'm going to be targeting up to about that $55 mark on gold. And then last but not least, silver. Silver waking up as well. It had just been getting beat down like crazy the last few weeks to month or so. And it is finally waking up and has a little bit of a head and shoulder pattern here. So here's the two shoulders. Here's the head. and now it is confirming higher out of the breakout line there. So anyways, silver looking like it's waking up. I probably like gold a little bit more, although silver can really just rip when it decides to. So I might see it coming back up to around 22 would be my guess. Anyways, I hope that helps, guys. Stay safe. If you're going to be trading this week, make sure you pay attention to that Federal Reserve meeting, 11 a.m. Pacific Standard Time on Wednesday, because that's going to be fireworks. We're going to see one way or the other where the Federal Reserve thinks our economy is and where we are going to be headed when we get that announcement. And I guess I'll bring it over here and just show that. So no economic data Monday or Tuesday. So I'm guessing we're kind of going to be in a little bit of a consolidation or just kind of messy chop those 2 days leading into this Federal Reserve funds rate announcement and then the press conference after. Thursday unemployment claims are going to be important. Flash manufacturing PMI is going to be important, but the big one is going to be this Wednesday, the Federal Reserve meeting. So that's the one that I am targeting and watching. So hope that helps, guys. Enjoy the rest of your week. Trade safe. And as always, you can message me either on YouTube or Instagram or in our Facebook group. If you're not in the Facebook group, feel free to ask to join. It is a private group right now, but if you flag and ask to join, I will accept you. And yeah, put your questions there and let me know what you think. Talk to you soon. Bye.